Hello everyone, and thank you for tuning into the North Main Minute. I'm Joshua Dobi. Pretty serious item that's hit the news cycles here as of the time of this video recording is with regards to our country's debt rating. Now, let's do a real quick 101. Not going to get granular on this, but real quick 101 on what that means. Every country is assigned by various rating agencies. Moody's and S&P are two of the most popular ones around the world and most often used. Each country is assigned a debt rating, meaning what is the strength of the management of their debt and of their overall fiscal financial picture. And here in the U.S., generally speaking, for most of our history as those rating agencies have been in place, we have been at the highest rating, which is a AAA rating. Well, we recently went from a AAA rating to a AA rating because of the possibility of future debt management issues and deficit issues in this country. I'm not going to get into those particular numbers right now. Just know that that's the reason why that the debt rating was adjusted to not a negative, but not nearly as sterling positive as it was previously. So what does that mean for you and for me? Well, frankly, up front, it's probably not going to mean much of anything. Meaning it's not like things are going to radically change overnight in ways in which you'll be able to recognize. However, I am going to raise to you, there are some things that are changing and probably are going to continue to change, and these may be material to you. First thing that's going to be out there, you're going to see yields rise, and we're starting to see that as of the time of this recording. Don't mean that they're going to spike up to where they were, say, 2.5 years ago, but I am saying that they're going to rise a little bit beyond where they are right now. Now, that's going to be fun for you folks who are more savers, money markets, CDs, U.S. Treasury bonds. That's going to be fun because your rates are going to go up a little bit there. Not going to be so good for borrowers, looking at auto loans, lines of credit, and mortgages. Again, I'm not talking about huge spikes. I'm talking about how they're going to increase a little bit above where they are right now, which very naturally happens in this kind of downgrade cycle relative to our debt rating. So what does that mean again practically? Well, I don't think I really have to tell you what that means then. If you're going to be talking about borrowing money, it's going to be more expensive. So again, I'm not talking about huge spikes here that you need to run out and get a line of credit or mortgage now because rates are going to shoot through the moon. I'm just talking about this kind of movement, generally speaking, has an adjustment to interest rates where they increase, and that's what we're starting to see right now. So we're offering this up to you, A, to make you aware of it, but B, so if you need to make adjustments, and especially if you have any kind of credit which has a variable rate associated with it, variable rate mortgage, credit cards, lines of credit, those kinds of things which move around in terms of the interest rates that they charge you, this may be something where you see that rate start to rise again. So make sure you're aware of that as well. If you'd like to reach out to us, talk a little bit about what the macro economy looks like right now. Where do interest rates go from here? I know it's a really loaded question, nobody knows, but we certainly can talk about it, what kinds of factors are moving right now that may impact that in the future and your portfolio. Reach out to us at northmainfinancial.com.